If you have savings or investments, then that may be a trigger to complete a self-assessment tax return, although it's not the investment itself that tends to get taxed, but rather the income that it generates. This could be in the form of interest, which would be subject to tax at the usual rates of income tax if it isn't covered by either your personal allowance, your personal savings allowance, or the starting rate for savers, which might apply if your total income is below £17,570. You may also receive dividends from your investments, which are taxed using their own specific dividend tax rates, and again, any dividends covered by the personal allowance or dividend allowance are tax-free. And finally, you may be taxed on the gain that you make when you're disposing of an investment. Typically, this is calculated as the proceeds of disposal less the cost of acquisition, any transaction cost, and any cost associated with improving the asset. Just note, the personal allowance cannot be used to cover capital gains, but instead, individuals benefit from a separate capital gains allowance. Any gain that isn't covered by this allowance would be taxed at the capital gains tax rates, which could be 18 or 24%, depending on your level of other income.